Hi, everybody. It's week 10 of the Online Investor's Guide to Thriving. And I remember as the first of our live events approached in early March, trying to figure out which of them would actually run. Would the first ones in Eastern Canada be live, and then we'd have to switch to a webinar? And perhaps in late April or early May, the shows in Alberta and BC, we wondered if those would be live again. And now here we are, 10 weeks in, and we have no idea when we'll be doing live events again. But this is the last of our weekly webinar for the season, at least. What we're going to do is switch to a monthly format, the last Thursday of every month at 7 p.m., starting on June 25th. We'll do a digital event with Larry, similar format to what we've been doing every week for the past 10 weeks. But there's still plenty of ways to get your finance fixed between now and June 25th. Our friends at BMO ETFs and the TMX continue to host a weekly Market Insights webinar, which you can opt into via the post-event feedback survey that you'll receive. And you can catch Larry on BNN. They seem to have settled on running BermansCall at 4:30 p.m. Eastern on Fridays, at least until Justin Trudeau relinquishes the Monday 11:30 a.m. time slot. You can sign up for our newsletter, or you can visit us at BermansCall.com. Lots of ways to stay dialed into our stream of market consciousness. Better still, in this post-COVID zero-rate world, let us do the hard work for you. We've partnered with BMO to offer ETFs and funds of ETFs managed by Larry and available to you through your online brokerage or investment advisor. Now, if you don't have an investment advisor, but do have a portfolio of $1 million and up, our ETF Capital Management Private Client Wealth team would be pleased to offer you a wealth management proposal. As you'd imagine, this way of working together allows us to make the fullest use of our wealth management and investment toolkits. You can learn more or request a proposal online at etfcm.com. If you just want to watch a replay of tonight's webinar, or in fact any of the past 10 weeks episodes, all you need to do is complete that post-event survey, which you'll receive tomorrow morning in your email address. That'll contain the survey, and all you need to do is tell us how we did, and you'll get a link to access all of the above, as well as submit questions for the June 25th webinar with Larry. Investor's Guide to Thriving comes to you at no cost in favor of two causes that Larry and I believe passionately in: sick kids and the Baycrest Foundations. We hope you can join Larry and I in supporting childhood leukemia research at sick kids, and we appreciate your support for the groundbreaking work being done by the Baycrest Foundation into the treatment of Alzheimer's and dementia. For those of you who have made donations, thank you so much. And if you'd like to make a donation, please use the links in the survey you'll receive after the event. Thanks also to our sponsors who all made the leap with us to this bold, all online format. Then again, innovation is nothing new to BMO ETFs. We've been proud to partner with them on ETF investor education since they first launched in 2009. We've also been proud to power at least one out of $62 billion in growth they've seen since then. And now to supply some ETF insight to you, our viewers, I'm proud to introduce Mackenzie Box from BMO ETFs.
Thanks, Jared. Hi, everyone, and thanks for joining us tonight. So I'm going to walk you through some of the BMO ETF resources that we have publicly available for you. So first and foremost, I wanted to just introduce you to our ETF website, so bmoetf.com. And this really houses everything from educational resources, such as quick videos, to product performance information, and various other tools to help select an ETF that suits your needs. So just looking at the screen here, you can see we have two videos at the top, which are kind of quick snippets, ETF 101. And then if you look to the right side, we have a few different links highlighting our ETF tools, ETF podcasts, and then on the left-hand side, we have news and insights, which help keep you up to speed with things we're doing at BMO ETFs and as well within the market. So that's just kind of a quick overview of our ETF website. And if we dive a little bit deeper, we have our Learning Center, which is really an interactive ETF 101 hub. So here you'll find things that really explain what is an ETF, some of the benefits, some insight on trading, and a few short videos that dive a little bit deeper. As well, if you scroll through our ETF Learning Center, you'll find some various ETF strategies that you can apply to your portfolio, as well as some common FAQs and glossary. So I would encourage everyone to check that out. If this is somewhere you haven't been, there's a great amount of information there. And then just building off of our Learning Center, we recently launched a YouTube page with all of our educational videos. So this also houses a bunch of webinars that we've done in the past. So as Jared mentioned, we've been doing weekly webinars. So if you visit our YouTube page, you can view ones that have happened in the past, as well as product deeper dives that we've done in the past, some other kind of ETF 101 videos. So that is all publicly available for you on our YouTube channel. And so now diving a bit deeper into our ETF tools, I mentioned earlier there was a link on our homepage where you can navigate to our ETF tools. And this is one of the most widely used items on our website. So we have 3 different tools that are all publicly available: a comparison tool, a screener, and a proposal generator. But today we're just going to look at the comparison tool as well as the screener. So if you look there, the comparison tool allows you to compare up to 5 different ETFs at a time. And you can pick from any Canadian listed ETF, and you can dig a little deeper into the different items that are maybe apparent to you. So if you want to look at performance, if you want to look at holdings, or various other metrics, it's relatively interactive. And if you also want to, I want to highlight, if you want to learn a bit more about a particular ETF, in the top there, the blue ticker, you can actually click on, and it will take you to an overview page that has more information about the particular ETF, and it also links back to the ETF provider's website. So this comparison has lots of great information. It's a good snippet when you're looking at different ETFs against one another. Looking at our ETF screener, this is a tool more to find an ETF that fits your criteria. So you can screen for an ETF based on AUM, provider, performance. There's various different elements that you can screen for. So one of the things that I think is really valuable, and you can see it here in the screenshot, is screening by a particular holding. So in this example, we've screened for all ETFs in Canada that hold Amazon. And if you look on the screenshot, you'll see at the top a list of BMO ETFs that hold Amazon, and as well all other providers and all other ETFs in Canada that hold Amazon. So that's just a nice, I think, tool that everyone can leverage if you're looking for exposure to a particular company or stock. And now just shifting gears to our ETF dashboard. So that was everything that's housed on our ETF website, bmoetfs.com. Our ETF dashboard, which is bmoetfs.ca, is an advisor-based tool, but it is public. So if you've got the basics down on ETFs, but you want to learn a little bit more, you want some market insights, or you want to read more about various ETF strategies or trade ideas, you can go to the ETF dashboard. It's all publicly available, but it's a little bit more in depth and has different items that you can kind of go through. So one thing that we'd highlight here is the News and Resources tab. And this is something new that we've done given the current environment. So we've posted lots of news articles relating to COVID, but specifically to ETFs. And then if you scroll to the next page or next slide, there is a tab at the top for trade ideas and podcasts. So we've also shifted a lot of our support, and we've been doing weekly podcasts, and we've also been doing almost weekly trade ideas as well. So if you're looking for more information on particular ETFs, you can see in the screenshot here, there's a podcast on ZPay. There's some trade ideas on best practices. So there's lots of information available there that I would encourage you all to look through when you have a moment. And if you want to find out more information about particular ETFs or strategies, between our ETF dashboard and our ETF homepage, there's lots of information there. So all publicly available for you to use at your own leisure. Thanks so much, and I'll pass it over to Larry.
Thanks very much, Mackenzie. And again, we love partnering with BMO for their really impressive suite of educational products. And I always say, you know, and emphasize when I'm trying to educate Canadians about markets, that you have to understand your toolbox. Like if you don't know the tools and how to use them, you're just not going to have the best experience and ability to make decisions that you could have. You know, I've been a big student of markets for about 35 years now, and even today continue to learn lessons. The biggest one is don't always be a bear, I guess. but you know, I'm not a bear. I've talked about for weeks now. Last week we talked about the eye of the storm. Today I want to talk a little bit about my approach on risk and return, and I'm going to take you through my shopping list and look at some of the current risks and returns of the things that I like best coming out of this crisis period. And then I'm going to open it up to Q&A here, because after 10 weeks now, it's getting very, very hard to keep these things fresh and exciting and new and interesting, and always trying to come up with new ideas, where every week I'm telling you, don't buy into it, don't believe it, don't believe it, don't believe it. In fact, we got a few questions that came in and called me out on that. So I'm going to address some of those issues, and always happy to be called out when you're in a public forum like I am on TV, and I've been doing it now coming up on, well, it's been over 20 years now. I was on the very first week, I was a guest on the Market Call show on BNN, and 7 years later, they figured out that the ratings when I was on Market Call were the highest of any guest they ever had, and wanted to offer me my own special version of Market Call, which is what BermansCall has now developed into in the last 13 plus years now that I've been doing it. So, you know, I talk about sleep at night, and I love this graphic, these two together, because it really emphasizes my my view of the world. When there's a lot of underlying risks, you simply have to take less risk. when the markets are at a high point, and the challenge, of course, is you never know when the high point is the high point. Someone had commented, well, Larry, you're a technical analyst, you should know that. Okay, so that's a very naive point of view, because you know, when I was an analyst, and just an analyst who was only responsible for my own P&L, i.e. my personal trading account, and not a fiduciary, and not responsible right now for coming up on $2 billion worth of, you know, Canadians' lifelong savings, you can't just say, oh, I'm bullish one day and I'm bearish the next. Oh, we got on US small caps today, we got a dark cloud cover. Well, the candlestick charts will tell you that's a very bearish pattern, but they don't tell you more than it's bearish. So you've got to now figure out, do you short it? Do you have less of it? Is it a 2-day phenomenon to be followed by higher highs? Because I'm going to show you some charts where you just don't know. And so it's very, very different when it comes to constructing portfolios. Someone just asked a question, how much gold should I have in my balance fund? Well, it's a great question, but the answer, Barry, is I don't know enough about you to tell you what's appropriate for you. So the correct amount is understanding the risk, understanding the potential return when gold is at $1,700, right? So what's the upside potential, and so forth. So we'll look at a couple things like that. And so how much risk should you take? Because risk and return, when it comes to investing, are linked, but they're not linked geometrically as this red line graphic that for each incremental unit of risk, you get a higher return. It doesn't work like that. But for every unit of risk you take, you should demand a higher return. So again, at $1,725 on spot gold at the moment, or give or take where it is, how much risk should I take? Well, what's the answer to that? Well, what's your time frame? You know, how far are you looking out? And so I don't know the answer. When people ask very good but simple questions, you can't possibly answer them thoroughly enough. When you look at how big gold is as an asset class, when you take gold equities and precious metals all together, it's like gold, silver, all the mining stocks that represent gold and silver, all the ETFs, it's like 1% of the world. It's a tiny, tiny asset class. So what's appropriate? 5%, 10%, 20%? It's going to depend, because that dollar that's now allocated to gold could be in equities. It could be short equities. It could be in dividend paying stocks. It could be in bank stocks. It could be in other mining stocks like base metals and so forth. So you always have to look at that individual bet that you're going to make at any point in time, whether it's gold or anything else, and compare it to everything else that you can put your dollar in that day, including cash, the safe investment. But the safe investment today is safe from capital loss, but it isn't, because a year from now, holding cash is going to be eroded by a weaker purchasing power parity, meaning your dollar today buys a dollar of goods, but next year, after inflation, might only buy 99 cents of goods. So you might think you have more money, but you really don't. Okay, so there's so many aspects to investing. But for me, folks, and what I talk about all the time, sleep at night investing, is making calculated bets. And whether the market keeps going higher in the next few months, I couldn't tell you. And there's nothing on the charts with certainty that can tell you. So at any point in time, you said, what's the probability of it going up versus going down, and by how much? And if I'm reasonably good at estimating, then you don't have to be perfect, because you can't be. But if you're really good at it, you're right 65% of the time. That means 35% of the time or 40% of the time you're going to be wrong. If you're not good at estimating, you're going to be wrong 50% or more. Don't even bother. Just buy a low-cost approach to the market, like a balanced ETF, and do nothing with it. But if you're going to take an active approach, then you have to think about the markets like this, in my humble opinion. And if you have a different view of how markets work, that's fine. No issue with that. What I talk about is what I do and what I try to teach people about what I do. So it's been the same list. These are thematic holdings that I like for the next number of years or longer, or for very specific purposes. And I've talked a great deal about why I like bond duration and yield, so long bonds, and I'm going to talk a little bit about those. Gold and different ways to play it, whether you're buying gold or gold equities. The young and emerging part of the world coming out of this crisis, I think does very, very well, but in the short run has some significant problems. India has no practical way, in a good sense. If anyone's ever been to India and viewed some of these slum areas, for lack of a better explanation, where you've got 1 million people living in a city square block, you understand that the medical care and everything else just isn't there. And there's no social distancing, there's no masking, there's none of that. So you're going to see rampant spread of the virus as it gets into these communities. And India, sub-Saharan Africa, there's lots of places that are, a tier below emerging in many cases, that are going to be ravaged, and they're going to need money. And the vast majority of them have come to the IMF and said, we need help. And so in the short run, some of these areas, they're going to be very, very stressed. Nigeria, one of them in particular. And then there's, how much debt is there in the world? Because it was bad before the crisis. It's magnitudes worse today. We're in a global environment where we're at best case 1 to 2% global growth. And in that view of the world, how do you get your yield with less risk? And I've talked about ZPay a lot. I'll go into that a bit more detail as well. And avoiding companies that have been buying back shares. They're going to be punished significantly. A lot of the big tech names are going to be punished in antitrust, especially if we see a change in government in the US. These are very, very big issues. I do think there's going to be a change of government in the US. And so you can trade for a month or two here, but there's almost certainly going to be a second wave. Anybody who thinks that's not the case is naive, but many people think we're past the worst. A lot of people say we're going to get, the vaccine. When you talk to some of the smartest people in the world about forecasting, there's a group of people that I'm part of called super forecasters, and they think that within a year, the probability of a vaccine, based on all of their collective opinions that are based on scientific and other means, 6% chance. The market right now, given the bounce back, I would say is 70, 80% chance. So there's big room for disappointment here. I love technology going forward. Anything that's going to make our lives easier is going to be big, and I'll look at some of those. We're going to have a massive inflation at some point, without a doubt. Just saw a headline cross here. Brazil reports 26,417 COVID cases, a new daily record. There's parts of the emerging world that just can't contain this. One, the leader of Brazil is an absolute moron. I hate to say that about a world leader, but there's some others that fall into that category too. That I'll go nameless. Anyways, we've got this coming inflation problem once we get through the deflationary shock. I'll talk about how to play that. And then next big thing to put people back to work is going to be infrastructure spending massively globally. I'm going to show you how the correct way to play that. How people think about infrastructure ETFs is not the way to play that. And then a little bit on hedging. So let's get into it. Interest rates. So long bonds. This is a chart here, folks, of the US 10-year interest rate. I think we will test negative US 10-year rates before I'd feel comfortable saying it's over. That's been the case in Japan and in Europe for a number of years now. So it's impossible to say, based on how much stimulus and yield curve control that the central banks put in place, as to how long interest rates are going to stay anchored at very, very low levels. But the best way to play duration is through long bonds. And the longer maturity, the better price performance. So you can see here a chart of the last 5 years of the PIMCO zero coupon bond. So a zero is a strip bond where you're getting maximum price response to the changes in interest rates. And you can see when yields go down, rates go up, how well that white line outperforms the traditional long bond. So that ZROZ is the maximum bullish you can play interest rates. ZTL is a US dollar long bond like TLT, but it would be a way to play that US long bond here in Canada. And then TLT is the biggest long bond ETF in the US, 20 years and longer. So, when are interest rates going to bottom? When is this inflation coming? I don't have the answer to that because we can't know. It's within the next 2, 3, 4, 5 years for sure. It's far too early to play the inflation card today. So what this chart is the break even on the 5-year. So what is a break even? So this is basically the difference between the nominal yield and the real yield. So we have these bonds called real return bonds. You can buy them in a whole host of ways. These are two ways. So ZRR is the BMO Real Return Bond Index in Canada. STIP is short-term Treasury Index Participation, TIPS. Treasury Index Participation, what it stands for, and S for shorter term, so not longer term bonds, which is probably the better way to play it because inflation expectations tends to be something you look out a couple of years on. So on the recent shock, we saw the spike down, but we didn't go to a negative yield. But inflation expectations for a number of years has been anchored between about 1% and 2%. And you've heard the Fed talk about, and the Bank of Canada talk about this 2% target and how difficult it was to get inflation expectations towards 2%. And we've had periods of it. But remember, when the inflation expectation turned to above 2%, and you can see it started turning higher into 2017 into 2018, inflation expectations were going up, the Fed started to raise interest rates. Remember all that? And they were able to raise interest rates about 225 basis points before the equity markets had a stroke in the fourth quarter of 2018, and inflation expectations came down again, and the Fed started easing. And we're in this world where we can't normalize. Any central banker, any real banker, Jamie Dimon is probably the worst. He is just so full of shit when he talks to the public about what he thinks on interest rates, and how he just came out the other day and said, we don't think we're going to have to write off anymore. We think we've provisioned enough. He's on acid. We have a year or two of economic pain to go through in the next year for sure. Now, it is a bit of a game changer if there's an effective vaccine and everyone trusts it and takes it, and we all go back to work and we all go back to restaurants. But that scenario is the 6% scenario. It's not the 80% scenario. The 80% scenario is they find stuff that might work for some people and not for others, and they've got some viral treatments that minimize death, but the remdesivir one is only given to people on IV after they've been intubated, right? After they've been on the ventilator. 80% of people who get to that stage die. So maybe it's only 60% die once you get to that stage. So there's but yet Gilead stock took off, and oh, wonderful. You got a lot of fast, dumb money chasing dreams. And you got 1 million new discount brokerage accounts chasing dreams. And I'm fine with it. Just don't ask me what dreams to chase, because that's not what I do. I'm the sleep at night guy. I'm the guy looking for the best return adjusted for risk. And maybe I'm very unique that way, but that's what I do. I preach active investing over passive. I like using passive instruments because it reduces company-specific risk. When someone asks me which gold company to buy, I can do the analysis. I could spend a month and I can go through all the income statements and balance sheets of all the gold companies, and I can get on their conference calls and I can call them all up and I can listen to their stories, and I can believe some of them. You don't know who to trust these days in the C-suite because they're all self-interested. Or you can buy the basket of them and understand that the theme is right and not worry about who the winner is going to be in the horse race, and just buy the basket and be diversified and get rid of your single company risk. And I love that approach. One, it's more elegant. Two, it's way easier to get the theme right than to pick the winning horse. And if you don't believe that, all you need to do is look at the whole industry and all the performance of all the mutual funds in history and say which one of them beats the index consistently? And the answer is almost nobody, and not even Warren Buffett. So, get the theme right, be in your asset classes, get your sleep at night on, because once you get your sleep at night on, your emotional, the emotional quotient that hurts everybody when it comes to investing is well managed. So how do you play gold? Okay, so questions on gold. This is GLD. It's the biggest, most liquid gold ETF. I don't care if you can't convert it for size. If that's a thing for you, then use the one that you can convert. Okay, no issue. If you're using ETFs on gold bullion to invest, more than adequate, GLD, CGL, you don't need to convert them. If you believe the government's coming and they're going to confiscate your gold, then go buy your gold bars. You can't trade those. The spreads are too wide. You got to run downtown to the gold vault to get rid of them. Don't bother. If you're trading for investment purposes, the ETFs and this one or these two, more than adequate. If you want some leverage, you can play the miners. They're going to have about twice the volatility as the bullion will. So if you want my most defensive way to play gold bullion, where I want to be in the space, but I'm concerned short term, you can go sell it and go to cash. But the most defensive way to play it would be in an ETF that would have a covered call overlay. So there's one for GLD with a covered call overlay, and for the life of me, I'm trying to figure out the ticker on it, and I can't. So I apologize for that. So the most defensive way you can play is gold bullion with a covered call. So you're generating a yield on your holding, and you're doing it with less standard deviation. The next best thing you can do is gold bullion outright, no covered calls. You're playing, but if you want some leverage to the upside, you go into the miners. And if you want a lot of leverage, you go into the junior miners. If you get into the leverage ones that rebalance daily 2 times, 3 times, you're going to get absolutely crushed. And when we got into that volatility event in March, and you saw gold bullion go down hard for a couple of days, and gold equities get cut in half, those double and triple ETFs got wiped out. And do you want to play that game? So you got to decide whether those are appropriate. But as the conservative guy, I'm never going to recommend you do that. So where does this go? On past webinars, we talked about retest of the high being a virtual layup. So 1900 for gold, I think is reasonable. Sometime within the next calendar year, maybe a bit less. And how far do we go above that when it breaks out? Because I think it will break out, because the central banks aren't done with their largesse by any stretch of the imagination. And this has potentially years to run. I have no idea how far it can go, but I can measure some technical targets, 25 to 28, 2900 projected out a few years. Reasonable on a chart basis to see prices like that. So, potentially another 50% higher from 1700 within a couple of years. There's nothing or very few things today that I would say have 50% upside. And the gold stocks from these levels probably are a double. And again, very few asset classes that have that potential over the coming years. Emerging markets, here's where it's interesting. So what I'm going to do here with emerging markets here is I'm going to bring in some charts and have a look at some of my favorite holdings. So when we look at what to hold in emerging markets, so I'm bringing in here my Bloomberg screen, and see if we can all see that here. Is everybody able to see this screen here? Yeah, we should. So I'm going to bring in one of my ways I like to look at some of these ETFs. And so this is Vietnam. I think if supply chains move around, demographics, debt, everything about Vietnam seems to be quite positive. So what I'm doing here is I'm comparing Vietnam, VNM, and I'm doing it relative to VT, and VT being Vanguard Total World ETF. And I like to buy stuff when it's relatively cheap. So on the top line, I've run two regressions. I've run a 1 year and a 3-month regression. Those are the channel lines that you see there. And I'm not sure if you're going to be able to see my my mouse here or not, but let me see if I can line up here on the chart where we got some interesting signals. So right here and right here are two interesting points for me. So on an absolute basis, the absolute low was made there, and that was date-wise the 16th. And then on the 30th, we made the relative low. So Vietnam bottomed on an absolute basis on the 16th. It made a relative low to the world index on the 30th. And you'll all remember that the S&P 500 made its relative low actually on the 23rd. So, not everything's based on the US market, but that looked interesting to me. I didn't add to my portfolios because I'm still quite concerned that we can see lower lows here. This is the relative performance. So the ratio from a year ago, this is 89.74. So a year ago, it was at 100, and now it's at 89. So that means Vietnam is underperformed price-wise compared to the world index by about 10%, a little over 10%. And at the low here, the relative low, that ratio was 78.88. You can see there approximately in the margin. So that had underperformed at that point by a little over 21%. And at the absolute price low, that ratio was around 84, so underperformed by 16%. So when part of the world gets cheap, for me, that's when I want to step in and buy it. So I look at for absolute cheap and I look for relative cheap. Because again, on the relative basis, where am I going to put my money in the world? That's the question, right? Today, what's cheap in the world on a relative basis? Well, Vietnam in the last couple of days is much closer to the higher end of the relative range than the bottom. And so I'm going to wait until it gets absolutely and relatively cheap again. And that's probably the time that I will step in. Now I've got my favorite indicator RSI for overbought, oversold. And you can see on an absolute basis. So this is the RSI of Vietnam on an absolute basis. So the top graph, this is RSI, but on a relative basis. So it's the RSI of the relative strength chart. And so I want weak relative strength, a positive divergence in my RSI, which I saw both cases here. So that was a good point. What got in my way was the absolute risk of the market, and I didn't want to add a lot of exposure. But Vietnam is on my buy list. So when we look at what else is on that list, we've got frontier markets, FM. So let's have a look at frontier markets. And that's in the US, FM US, frontier markets. And so here's one that's closer to the lower end of the range, hasn't recovered much. But remember, these are the markets that are probably going to struggle with this a whole lot more. And so you got to be very cautious, very high risks here on a relative basis. I'm going to bring up the portfolio function. And what the portfolio function on Bloomberg does is it loads the underlying stocks into the portfolio that it owns. And so we can see when we buy frontier markets what our exposures are. very interestingly enough, real estate is actually the biggest component when you talk about some of these markets. As you might imagine, it's guys building office towers, and as these cities are emerging, real estate is actually a big part of that. So when you click into that and you say, well, what is it? You've got Nova Land Investment, Vincom Retail, Vin Group, Vin Home. Sounds like those three are similar markets. So what's our exposure by country? So let's see if we can do that. And so let's go country of risk. So let's have a look at country of risk. Now, you guys can go on the website of the Van Eck Vectors Vietnam ETF and drill down and see. Oh, sorry, this is loaded the Vietnam. That's why it didn't grab the frontier markets, because I didn't go into it the right way. Let's go into the frontier markets. So in Vietnam, you're getting a lot of real estate exposure. Let's go into the frontier markets one. Sorry about that, guys. I've been using a Bloomberg terminal for over 30 years now. So financials, as you would expect, banks, and you can see all the banks there. So let's have a look again quickly and look at the countries of risk within the frontier markets. So you'll be able to see here where so you've got Bahrain, Middle East, Bangladesh, interesting, Jordan, Kazakhstan, Kenya, Kuwait, big part of the Middle East. You've got some Vietnam in there, Romania, Sri Lanka, Nigeria, and so forth. So what do you own when you get exposure to Nigeria? Well, obviously you own financials. So you've got a couple banks there and trusts. What's in the consumer staples? Nestle's Nigeria, how about that? I guess they like chocolate there too. MTN Nigeria Communications, so you get the phone company. How about on the mining side? Cement company. Well, that kind of makes sense. So it's kind of interesting to dig down. Again, you can go to the website. In this case, it's an iShare. You can go to the fact sheet and you can see some of these kind of things for the do-it-yourselfers at home. Love emerging markets. You got to do your homework. I can't emphasize that enough, but I'm not buying a lot of these things at the moment. Okay, technology. So we're going to do some drill down here as well. So let's have a look at this G2 screen, and this is for cyber. Again, I want to buy it when it's cheap. I want to buy it when I have some intrinsic value. We've come quite a bit off the lows. You can see on an absolute basis, we're getting overbought. Okay, you can see that we're getting overbought here on our RSI. Our relative RSI, top end of our trading bands here. Again, 115 was the ratio. At the bottom here was 100. Now, when this yellow line is rising on trend, this is a sector that's outperforming. So you want generally a rising line relative to the world. That tells you it's something that's outperforming everything else on average. And you want to buy it when it's cheap, i.e. when it's oversold. If you buy it today, it's 15% above neutral to the world. So it's not cheap. Doesn't mean it won't keep going up, but it's not cheap. And my style of investing, guys, is owning stuff when there's better relative value there. So let's have a look at some of these other ones. Let's have a look at ARCW, Next Gen Internet. Okay, so let's do a quick look through on the portfolio and see what sectors we hold and some of the holdings. So we're grabbing some of the data for this portfolio here. Communication services, so that's kind of telecom. So you got some Baidu, some Facebook. That's kind of the internet, new internet sector. Then you got some consumer discretionary, so your Amazon falls in there. Or your Tesla, so next generation technology, Alibaba Group. Interesting. Got some financials. What's in the financials? So you got some floating rate notes in there. That's interesting. Wonder why. Healthcare, Teladoc. So I think Teladoc is one of these companies that can help us with our online medical. And then of course, traditional technology, Adobe, Apple, NVIDIA, and so forth, PayPal, Salesforce. Salesforce reported some bad numbers today after the close and was selling off aftermarket. Let's have a look at this one on a G2 basis and see how that's going. So this is a good one. It's outperformed the world by 50% over the last year. So you want to be in stuff with positive yellow lines, and you want to generally buy them when that yellow ratio, when you're getting a relative sell-off and it's relatively cheap. Okay, can't overemphasize that enough. You don't want to buy them. Doesn't mean you can't, doesn't mean it won't go up, but it's not the best time to step in. So if you're a momentum trader, sure. But even momentum traders should be buying on pullbacks. And so again, I look for my overbought, oversold on my RSIs, and I look for my buying opportunities for the things I like. Let's look at SNSR. What is that one? The Internet of Things. Again, here's another sector, long-term, good outperformance. You want to buy it, and you want to buy it when it's cheap. But folks, if we're going to get another sell-off, look at what happened on relative performance during the sell-off. So the big flyer names get crushed. They just do, because these are not mature companies. These are companies with very uncertain earnings. And the first thing that gets cut is CapEx. So while they may still be investing in technology, the overall budgets are down 10%, 20%, 50%. I talked to my business partner, Jared, who you heard from at the top of the call. Markets are turning down. What do? Well, we look at our budget. The last thing we want to do is lay someone off. First thing we do is, well, what can we cut? That's what the C-suite does at a company. And capital expenditures are discretionary spending, and those are the first things that go. So a lot of these great areas, or the investments will come back, and that's why they snap back so quickly. How about robotics, ICLN, clean energy? This is a very interesting one because long-term I love it, but it hasn't been a great relative performer per se. Now it's starting to come back a little bit, but if I were to show you this chart on a 5-year basis relative to the world index, on a 5-year basis, 5 years ago, this thing was at $12.35. It's at $11.70 now. It basically pays no dividend. It's underperformed the world index. The current ratio's by about 16%. So that's something you want in your portfolio. Well, for the last couple of years, the ratio was down at 59 here. It's now at 83. So it's now becoming a better relative performer in terms of clean energy. But it had been for years a terrible performer. Very, very interesting to note there. And then we can look at one last one here. This is ARCG. This is a biotech. So genomic revolution. We'll look at the 1 year there. So biotech is hot now. It's outperformed by 50% over the last year. It was relatively cheap back in October, November. Got relatively cheap again on the recent sell-off. That ratio was 105. It's now 149. But as you can see, the last couple of days here, as some of these biotechs have come off, this is underperformed at the peak. It was 173, and the ratio is now 149. It's underperformed in just 3 days by over 20%. Is that something you're comfortable trading? I can't tell you the answer to that, but when you look at it and look at the behavior, you got to understand that this is a volatile SOB of a thing to own in your portfolio. You have to buy it on weakness. If you buy it on strength, you have to have massive intestinal fortitude on this stuff. Okay, so let's move on past technology here. I love it. It's going to be a major part of my portfolios going forward. Now, finally, infrastructure. Okay, so I apologize, I didn't change the chart here. So let me bring back. So here is the biggest global infrastructure ETF, IGF. And I'm going to show you what's in it and tell you why this is not a great one to own if you want to play infrastructure. Because what you tend to end up owning here is a lot of pipelines. In the energy sector, pipelines, you can see a lot listed here. Now it's around the world, not just in the US, but there's gas transport ET that trades in France. There's obviously a lot of US names as well. Vopak, that is a Dutch holding. So you've got a lot of exposure to pipelines. That is not an infrastructure play. You can think about it as infrastructure, but it's already built. It's not new. So they're not going to spend a lot of money building new pipelines, is my point. When you look at the industrials, you look at, well, what do some of these companies do? So you've got the Auckland airport. So you get airports. What are all these Fragport? So you get some ports. There's Grupo Aeroporto, different holdings there. Yeah, so you can look into what some of these companies do, but these aren't the ones. And then you get traditional utilities. Electric, these aren't growth companies. These are regulated dividend payers. So if you're investing in infrastructure for the yield, go for it. Have no issues. But if you want to play the companies that are going to benefit from the trillions of dollars in the world going to spend to fix bridges and roads, you want cement companies, you want steel companies, you want base metal companies. So if you look at the BMO ZMT, actually, so this is an equal weight global base metal ETF. And if we look at what's in that, you get a very different view of the world. But this is the way to play infrastructure, guys. It's not utilities and pipelines. You get aluminum producers, you get copper producers, you get zinc producers, you get nickel producers, and so forth. On the industrial side, not sure even what those two guys do. That's how you want to play this. You want to play this. So let's have a look at how the base metals have done in the last 5 years. Who wants to own that? It's at 51% of the world index. I remember I got a lot of calls. Larry, what do you think of the base metals? What do you think of copper? And I've been saying for years, you can trade it, it's not investable yet. And the reason I've said it's not investable yet is very simple, is because when the world is slowing and we've got all this debt, they're not putting a lot of money into infrastructure and therefore building. And the best of the Chinese build has been over for years. in terms of building all these cities and cement and steel demand, that's been over. It doesn't mean these things can't rally. They certainly can. But in a slowing world, it's going to be challenged. Now we have a catalyst. And the catalyst is every government in the world needing to put people back to work productively. And they're going to put them back to work largely with infrastructure spending. Okay? And these are the ways to play it. Not your traditional infrastructure, not your airport, owning the airport where you get a fee based off of how many planes land. That's not what you want to own today. You don't want to own toll bridges. That's fine if you're playing for yield. But if you're playing for growth, you want to play it in the steel stocks, in the copper stocks, and the base metal stocks. Okay, let's get into the Q&A of prepared questions here. So I've been looking at ZPay, and it shows 40.65% treasury bill holdings as of May 21st. How does this fit into the overall option writing strategy? So there's a terminology in the marketplace that when you're writing options, they've got to be cash covered. So that means if the options get put to you, you must have the cash to buy them. So while they've written the option to potentially buy all these stocks at lower prices, the money gets invested in treasury bills. And that's why it shows it with the exposure to treasury bills. But it's doing that to maximize the use of cash in the portfolio. And if a stock gets put to it, it sells the treasury bill and uses that money to pay for the stock. If on the strike date, or the date of expiry, not strike date, the date of expiry, the put is in the money, in which case you have to buy this stock. So ZPay, the buy low, sell ETFs, high ETF. So it's the combination of writing puts on great companies to buy them at lower prices, anywhere from 30 to 60%. And once they own them, 30 to 60%, write calls at higher levels on where they want to sell them, earning the income from the dividends of the stocks they hold, plus the premiums from all the options written, generating a 5 to 6% yield, and the current payout is 6%. So hopefully, Bob, that answers your question on ZPay. After Memorial Day, S&P passed its 200-day average at around 3,000. Yep. And the 61.8% retracement, yep, which was around 2950, all in one day, as per John Authors. I don't know who John Authors is. The Feds have averted a crisis. How long can this be kicked down the road? Please comment. Would ZPay and ZZD distributions be treated as income rather than dividends? So, first of all, if you hold anything in a registered account, it does not matter at all how the distributions are, because the tax occurs when you deregister the money. Okay, so be very clear about that. But in the case of a taxable account, ZPay, when it's holding a US company and that's a US dividend that gets paid, that's an income treatment. That's a CRA rule, right? So even though that ETF is paying the distribution in Canada, it's coming from a foreign corporation. Now, the distributions that are paid based on the puts or income, but based on the covered calls, are treated as capital appreciation. So you've got a combination of income and capital appreciation or capital gains in those ETFs. And it's similar for ZZZD, okay? I will hold on average somewhere between 5 and 20% in Canada. And so when I'm holding a distribution ETF like ZWC for Canadian high dividend covered calls, those will get the preferential tax treatment because the dividends are being paid from Canadian corporations. And that applies for everything, not just my ETFs. Everything. Wendy, I hope that answers your question. Ken asks, says, me and Rosie as well as many others, are great at explaining the disconnect between the real economy and the stock market and how the current evaluations are not justified. I understand and agree. You also make it clear that you're a value investor, but you are a technical analyst. And surely you can see that the market is the market and it's always right. So why are you so stubbornly hanging on to the belief that you should not be in the markets? Just look at the returns over the last several weeks. Ken, who said I'm not in the markets? I am in the markets. I'm in the markets with all my portfolios. It's the matter of the degree of risk I'm taking, Ken. And as a fiduciary, on your own, Ken, you can do whatever you want in your portfolio. But I've got mandates. I've got to generate a dividend. I've got mandates that are balanced. I've got mandates that are yield. I've got risk managed mandates. I've got long short mandates. I've got many different mandates. I'm always invested in different ways. But I might want to grow the portfolio with bonds or gold. So Ken, it's not just about being long the stock market. There's so many asset classes, and I wish people would actually hear that. And I'm not telling people to not invest at all. I'm just giving them my interpretation of what I'm doing and my view. And so you can blame, but it's very different being a technical analyst and being a portfolio manager. And Ken, they're night and day difference, because as a technical analyst, if you get the call wrong, you change your price target, big deal. Elliott wave count didn't work, no problem, there's the alternate count. I can't be in there every day buying and selling. Oh, trend line stopped, oh, stopped out, buy this, sell that. That's not investing. That's not how the institutional world works. Okay, so Ken, your understanding is fine for an individual investor, but it is not for an institutional investor. The world just doesn't work that way. Portfolio construction and mandates are how the real world works. You can't put $1 billion in and put $1 billion out based on a trend line. You can't do that, Ken. Okay, so I hope you can appreciate that point of view. And it's not about being bearish and all kinds of things like that. But having said that, I have never been more upset and disappointed with the world than I am right now, for lots of reasons. But it's not bullish. I can't be bullish that the central banks are printing money to buy high yield crappy companies. To me, that's a failure of the system. And you can interpret it as bullish and just chase the market and momentum trade. But I don't do that, Ken. Okay, so again, thanks for the question. I have no problem being called out. Again, as a public figure, I expect it, and I got to have an answer. I got to be able to justify why, and I hope that gives you some insight into it, Ken. Can I please explain the downside risk scenarios with ZPay? Absolutely. So Wayne, ZPay right now is probably long 30 or 40 or 50%. I have to check the exact number. And the next expiration date monthly is June 19th. And sometimes they'll write on the off weeklies, and it really depends on the portfolio manager. But they stagger it somewhere between 1 and 2 months out. And they look at levels that, you know, they're okay selling it there. It's a resistance point. It's at least one standard deviation higher than the current valuation, etc. and price. And when they're looking to buy stuff, they're filtering for great companies that they want to own, and they're writing puts at levels that they're happy owning them. So if the markets sell off aggressively, like they did, as the markets go down, volatility shoots up. This strategy is short volatility, meaning you sold the call, you sold the put. So you're short volatility. And as volatility spikes, that works against you. But ultimately, on the date of expiration, it doesn't matter what volatility is. because now the option is either in the money or out of the money, and all the time value and volatility value has eroded. So as you get closer to expiration, the theta and the vega, the volatility risk and the time risk, change. And the rate of change is called gamma. So you asked the question, Wayne, it's very technical on the answer. But basically, the more volatility there is, the higher the premiums, the better the yield can be, the better the performance could be. And it all depends on how it goes up and down, up and down, up and down. But it's going to pay you a yield of around 5 or 6%. And on average, they target it to have about half the standard deviation as the S&P 500. But there could be a scenario where it could be close to 100% long if you get a real big market sell-off and then it doesn't snap back very fast. In which case, you're long great companies at great levels, but it's not without risk. But in general, it's going to have about half the standard deviation of the S&P 500. Canadian banks posted huge profit declines and provisions for credit losses. These reports have triggered stock sell-offs, but we've rallied despite the news. I think the Canadian banks were rallying in sympathy with the US banks and not because our numbers were good or less than expected or anything like that. And the economic reality of COVID-19, we're in inning 2 here, folks. We've got a year or 2 or 3 of difficult economic times, high unemployment, mass bankruptcies. I've seen as much as 50% of restaurants will be out of business. I've seen as much as 30% of all small business will be out of business. Because it's fine if the government floats them a loan for a free interest rate. But if they can't sell their stuff and they ultimately have to pay rent at some point, forbearance for now, but not forever. Okay? If for the next year or two, they're allowed 3 customers at a time and they're having trouble making a living with 10 customers at a time, they're not going to make it. And there's a lot of businesses that don't do that. Small business at scale is called the Russell 2000. Russell 2000 is generally companies with a market cap less than $1 billion. And you don't think of a company, or $2 billion. They don't think of a company with $2 billion in market cap as a small cap, but that's the definition. There's approximately 2,000 of them in the US. And did you know in 2017 and 2018 and 2019, when Trump told us we had the best economy ever, that a full 30% of those small cap companies didn't make any money? If you don't think in this environment for the next couple years, even more of those companies aren't going to make it, we've got a huge economic wave to come that's not priced into this snapback. And there's a lot of hope and optimism here. So going back to the banks, these guys are the ones that are on the hook for the debt. Okay, so that's still got to be priced in. And in 2000 to 2002, and in 2007 to 2009, and this economic shock is worse and will most likely last longer, that the Canadian banks fell 50% in both those periods, and you don't think that's going to happen again? We're on different sides of the world. So I think there's more downside there. At the peak, the ZEB, Equal Weighted Bank Index, was a little over 30. Cut that in half, 15, 16. I get very interested in owning the Canadian banks at that point. The intraday low in March was $18. Didn't trade much there for very long, but that was the capitulation bottom. And that was close to value. So retesting those lows and lower, I think you got to start to like the Canadian banks again. At 24, 23 and change, you can't like them. Do you think the Dow to gold ratio is a good indicator and it could be adding? So let's have a look. The Dow to gold ratio. So we're going to use the Diamond ETF for the Dow. So DIAUS, you can see that. Let me get my mouse over there, and we can do a ratio, and I can put my GLD ETF here as the comparison. So we can look at that ratio, you see right there. And now we can max that. Let's see what happens here. So, so the writer asked the ratio of 5. So that would be the actual index. So let's do the spot market. So we can INDU. So let's take the index and let's take spot gold. So we can see that, and then we'll come up with that ratio number here. All right. So this is the ratio for the history that we have on Bloomberg here, going back a decade or so, and he's saying that I think the ratio of 5 would be an indication to go long equities. So that would be in sort of in line with the lows from 2011, it looks like. You know, interesting story. So around 2011, and I don't remember exactly, you know, give or take a couple of months to a year, I had Bob Prechter on my show, and those of you who are Elliott Wave people know Bob Prechter as the face of Elliott Wave in the last 30, 40 years. Wrote a book with Jack Frost in early 1970s about Elliott wave theory. So here's the ratio there. And do I think this is a good metric? Well, Bob was on the show, and the reason I bring that up, he was on the show here, and he was talking about the ratio going to, I don't even remember, but he was so wildly bearish on stocks at the time that you know, anyways, I don't think the gold to Dow ratio is meaningful from a timing perspective, because you look at it here, and you know, when I look at the regression statistics and then the correlation. Yeah, all right. So the regression tells us that these things have a very low, slightly negative correlation. So that means that the Dow and gold aren't related. And when you're looking at a ratio, what you're doing is looking at a rich, cheap kind of analysis. And for two assets that are not related, looking at a ratio is actually quite useless, because it's kind of like a buy low, sell high thing. And therefore the two should have some correlation, and they don't. So I think it's not the best tool, Scott. Tom asks, can I quantify and compare the levels of the correlation market or sector level that technical and fundamental analysis attributes to 3 to 6 of your choice have with market sector performance for 2 different periods in time back 10 to 15 years ago, when I suspect a reasonable level of correlation versus modern time pre-print. Curious to know which attributes to focus on going forward. Wow. If I'm understanding your question, Tom, you're asking about, you know, which indicators kind of work best, technical and fundamental. And I'll tell you, you know, there's a passage in Securities Analysis by Graham and Dodd, 1934, where they talk about, and the whole book's about how to analyze securities, and mostly fixed income. preferred securities, but it talks about the behavioral nature, and markets are irrational, and random walk is bogus, and markets move from extreme to extreme, and they're emotionally driven. So, you know, from time to time things work, and then they don't work. Value as a factor, for example, has not worked in a long time because technology and momentum for a long period of time was the bee's knees. So that was a big thing. You know, Warren Buffett, the advanced decline line peaked. Let me see if I can have a look here and bring up Berkshire Hathaway. Let me look at Max on Berkshire Hathaway. So let me go to, say, weekly, but then I'm going to go back to 1995 so we can see some detail. And let me zoom into this period here. So everybody will know that the market, so the broad NASDAQ, S&P 500, Dow, peaked in March of 2000. Well, that's when Berkshire Hathaway bottomed. And Berkshire Hathaway peaked in 1998. Okay. Warren Buffett went down 40% when the S&P 500 almost doubled. It's very important to understand when you ask a question like that you've asked there, Tom, and what works. And this is, to me, the most glaring example of underperformance and dramatic. And it's not because Warren Buffett is stupid, but it's because his style didn't work, and he owned no technology, and it was technology that was driving the bus. Not unlike today, where a handful of stocks have been driving the bus. Let's go back and look at this index. This is the value line, geometric average, and it's the average price of the average stock. So if you take every stock and kind of say, what's the price change in any given day, and make an index out of that. What we can see here is that the average stock peaked the same week Berkshire Hathaway peaked, and actually went down for a couple of years. Kept going down ultimately until the market bottomed. But it peaked with the advanced decline line, yet the market, so let me see if I can add, let me do this, and let me add chart 2 here. So let me put in NYA. So that's the New York Stock Exchange last price. Let me update this. And then let me bring in that line. And then let's do the zoom in here. So the New York Stock Exchange, the broad index, is not the NASDAQ. You know what? Let's throw in the NASDAQ too, because that will really drive home this. So we have the NASDAQ there, and let's just do the last price of the NASDAQ. Update that, and let's bring that in here too. So that's the broad NASDAQ. Okay, and let's zoom into this period here. Okay, so The average stock peaked, okay, right in here. New York Stock Exchange kept going up, but the NASDAQ that had a value of 1859, 1860, peaked at 5,000. So from year to year, the NASDAQ tripled. The New York Stock Exchange went from 6166 to, by the time the market peaked, not like 8% higher, but the average stock was down 20%. And that's kind of the market we're in today, guys, because if we zoom this out to today and we look at the last couple of years here, so the average stock peaked there and there. So what was 2018? What was this blow up here? This was the Trump tax cut, right? The anticipation of cutting tax. Once that came in, the average stock is actually down. Think about it. Now the market bounced back. New York Stock Exchange from the peak. So the peak was 14.1, let's call it, and it's at 12. So in percentage terms, from the peak to where we are now, the New York Stock Exchange 16.7. Let's look at the NAS, the broad NASDAQ composite, down 4%. What is the average stock down from the peak? Today's close, 22.62%. That's the world we're living in, folks. So, good question, but there isn't any. So it's dynamic. There is not anything technical or fundamental that's going to give you the answer. Okay, we're running out of time here. Let me go a little faster. Global economy is going through uncharted waters, and yet markets are priced as COVID is up, and away. What economic numbers, in your opinion, will have investors? So here's the same thing. So what's going to turn us over? The expectation now is for vaccine, and Fauci the other day said November, December. He's getting people jacked, and you're hearing Merck and this, and we got it. If that doesn't happen, but you've already seen, you saw today a massive increase in cases in France where they've opened up. You're seeing some of the states where they've opened up a little earlier, starting to uptick. So there's going to be a second wave, 100%. And the only question is how bad. But they're not going to shut the economies down again because they know they can't afford to. So in the next iteration of this, you're going to have problems. And you're going to have health problems. And that's just going to make it all kind of worse, I think. And that, I think, is the big thing, and it's not an economic number. I did believe at one point that we would see new lows with a lot of candidates in line for potential vaccine, market up third phase. What would be the catalyst to drive that? So everyone wants to know that. So I already mentioned that, Dolph, what it would be. And it is, it's the economic fallout. It's the realization that the economy isn't going to recover in a V. And it's going to be companies quarter after quarter after quarter telling us we don't know. But the companies that are working, that are growing earnings, those are the ones that you do want to own. So for a little while here, it's going to become very much a stock picker's market. And large cap technology in general is a good area. Would I explain which option strategy I'm using, if any, to hedge the next down move? So simply an option, caller, and I've explained it on past webinars where you're buying a put at the money. So today, let's call it 300 on the S&P 500, give or take a rounding error, and you're writing a call at 300. So you're buying a put and you're writing a call, and that position cost you nothing, basically the dividend, because it's called a synthetic short. It's no different from a risk perspective than if you were shorting the SPY ETF, for example, or buying the SH. But you can overlay that position and own all the stuff that you like. So you can own your big tech and you can own some emerging markets that's outperforming. Again, I don't recommend that here because the timing is not ideal on those. You want to buy those when they're relatively cheap. But you then beta hedge your market risk using the S&P 500. And I do a lot of that in my portfolios. It appears that small cap stocks are starting to perform well. So yeah, let's look at that. IWM is the big Russell 2000 small cap. So for the guy who asked me about being a technical analyst, let's have a peek. Yes, big bounce back. So let's look at some, retracement levels. So let's look at our Fibonacci's. So there's the high there. Let's look at the retracement. So we've retraced just under the 200-day, just above the 61.8. And today we got a reversal pattern. So what is that pattern called? It's called a bearish engulfing pattern. And while we didn't close on the absolute low, as you can see there, that's a bearish engulfing pattern. What's this pattern called here? That's another bearish pattern, calling it a spinning top. And it sold off for 2 more days and then recovered. And it didn't make a new high and made a lower low. And that looks really bad pattern there, except now we've got a higher high. So to the guy who says you're a technician and you should know, I call bullshit. You don't know. That pattern today tells us to be bearish, and tomorrow that pattern can be bullish. And it's not about trading chart patterns as a portfolio manager, because I can't be all in and I can't be all out every day moving billions around. It doesn't exist. If you're trading 100 shares of IBM, you can do that, IWM for that matter. You can do that. But look at small caps. Today, the interpretation is bearish. It's holding below, and it looks like it failed the retracement after breaking out for 1 day. I don't know. What do you think? Let's have a look very quickly on my G2, and then this is going to be the last question we have here. So again, IWM peaked when? In 2018. It's been making lower highs and lower lows since 2018. Wow. It's in a bear market. Do you want to own it? Or is this a short candidate? It's overbought right now on an absolute and a relative basis. Right here, it's a short. It's a trading short for sure. Anyways, folks, I'm out of time. So thanks for joining us this week. Again, if you're learning stuff, really grateful that everyone's been on these for weeks and weeks now. I've really enjoyed doing them. It's getting very difficult as the summer warms up to continue to generate a lot of interest in these, but really please support one of our charities. If you want to reach out to one of our partner companies, if you want to learn more about what we do with the BMO funds and the sleep at night portfolios, there's a lot of resources there for you. But again, if you've learned something, if we've helped you out, please, 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 $20, $50, $100, reach deep, $500, leukemia, cancer research, Sick Kids Hospital, dementia, Alzheimer's research at the Baycrest Hospital and Foundation here in Canada. Thank you very much. See you next month and see you tomorrow at 4:30 on BNN.